Real Talk Geelong with Kyle Madison, the monthly podcast that cuts through the noise and gives Geelong landlords exactly what they need to know right now. This episode is brought to you by the 2026 Jellis Craig Geelong Investor and Property Information Night happening Thursday the 4th of June, and trust me, you'll want to hear about it before the episode wraps up. I'm Kyle Madison, Property Manager and Investor Specialist at Jellis Craig Geelong, and this month we're going somewhere that makes a lot of investors a little uncomfortable. Tax, specifically Victoria's land tax changes, and there is a lot to unpack. If you own an investment property in Geelong or anywhere in Victoria, your holding costs have very likely increased in 2026, in some cases significantly. The question is whether you actually know about it yet. Today, I'm walking you through the key changes, what they mean in real dollar terms, and what you should actually be doing about it. I'll also cover what's happening in the Geelong market itself, because despite all of this, there is genuinely good news. And I've got some exciting event news at the end that Geelong investors will not want to miss. So stay with me. Let's start with the biggest change, the one that has had the most impact on everyday investors here in Geelong, the land tax threshold. For a long time, if the total site value of your Victorian land holdings sat below $300,000, you paid zero land tax. That threshold was a meaningful buffer for a lot of investors, particularly those with one or two properties. That changed dramatically. Back in 2024, as part of Victoria's COVID debt repayment plan, which runs all the way through to 2033, that threshold was cut from $300,000 down to just $50,000 in total site value across all of your Victorian land holdings combined. That is a six-fold reduction. To put it in practical terms, if you own a single rental property in Geelong with a site value of $200,000, you were previously paying nothing in land tax. Now you're receiving an annual bill. And across Greater Geelong alone, this change has brought an estimated 380,000 additional Victorian landowners into the land tax net for the very first time. That is an enormous number of people who may still be catching up to this reality. Here's a real-world example. An investor holding a Brunswick townhouse with a site value of $400,000 and a Tarneet house with a site value of $250,000 under the 2026 rates is now looking at an annual land tax bill of approximately $2,975, where previously they may have paid nothing at all. And that's before we get to what's new in 2026. The Vacant Residential Land Tax, known as the VRLT, has been progressively expanded, and from the 1st of January 2026, it now applies right across all of Victoria, not just metropolitan Melbourne, all of Victoria. It's also been extended to unimproved residential land in metropolitan areas that has sat undeveloped for 5 or more years. So if you're holding a block of land and haven't done anything with it, that is now firmly on the radar. The VRLT works on a progressive scale. 1% in the first year of liability, 2% in the second year, 3% from the third year onwards. And critically, it's charged on top of your standard land tax. It's not a replacement for it. The longer a property sits vacant, the more expensive it becomes. The two ways to avoid it are simple in principle: develop the land or have a tenant in place. You may be at risk if your residential land was vacant for more than 6 months in 2025. If you hold unimproved metro land that's been sitting undeveloped for 5 or more years. If your property was under construction or uninhabitable, you may still be caught, even if that feels counterintuitive. And if you're running a short stay property that doesn't meet the exemption criteria, that's worth checking too. There are a couple of other cost increases also active in 2026 worth flagging quickly. If you're using platforms like Airbnb or Stays, a 7.5% short stay levy on gross accommodation revenue now applies statewide for stays under 28 days. That comes directly off your net yield, so it's worth factoring into your numbers if short stay is part of your strategy. From the 1st of July 2026, the Emergency Services and Volunteers Fund levy also increases for non-principal place of residence properties. It's a modest amount, but it is a real annual cost. And there's a rule change that affects anyone planning to sell this year. From the 1st of January 2026, vendors are prohibited from passing land tax costs onto buyers in sale contracts below $10.7 million. If you were factoring that into your net proceeds from a sale, that calculation has changed. Now, let's talk about what you can actually do, because there are practical steps you can take right now. First, review your 2026 land tax assessment from the State Revenue Office. Errors in ownership records or exemption status are more common than people realise, and you have 60 days to dispute them. Don't let that window close. Second, check all of your Victorian land holdings for any vacancy in 2025. Understanding your position now is critical for 2026 compliance going forward. Third, recalculate your cash flow with all of the new holding costs factored in, land tax, VRLT risk, levy increases and the short stay levy if it applies. Your yield may look quite different once those numbers are properly in the picture. Fourth, consider your ownership structure. Distributing holdings between individuals can keep each person's total taxable value lower, which can potentially reduce or even eliminate your liability. And fifth, if you hold properties in trust, please talk to a tax advisor specifically about trust surcharges. They apply on top of standard land tax rates, and the numbers can be significant. I did promise good news, and the Geelong market itself continues to be genuinely compelling, even with the increased tax environment. The median house value across Greater Geelong is currently sitting at $793,000, up 3.2% over the past year. Rental vacancy rates are consistently below 1.5% across most suburbs. That is an exceptionally tight rental market, and it continues to work in landlords' favour. Suburbs like Belmont, Grovedale and Whittington are seeing strong investor demand right now, and the Geelong Fast Rail project continues to improve the city's long-term appeal for both tenants and buyers looking further afield from Melbourne. The key takeaway for 2026 is this: informed investors who review their strategy and adjust accordingly can still achieve strong outcomes in this market. It's the investors who don't review their position who risk being quietly caught out by costs that gradually erode what looked like a healthy yield. Not sure how these changes affect your specific portfolio? Reach out to me directly. I'm here to help. Mobile 0400 466 115 or email calmadison@jealouscraig.com.au. Details are in the show notes. Before I let you go, on Thursday the 4th of June 2026, Jealous Craig Geelong, proudly supported by Safe Inspect, is hosting its annual Investor and Property Information Night at GMHBA Stadium's Higher Mark corporate venue right here in Geelong. This is a free event. You'll hear from expert speakers including REIV, President Jacob Kane, get the very latest Geelong and Victorian market insights, and connect with up to 200 of the region's most active property investors, all in one room on one night. Doors open at 5, speakers start at 5:30, and we wrap up at 7:30. Places are strictly limited and they will fill up. Email us to secure your spot. The link is in the show notes. Please don't leave it too late. That's a wrap on April's episode of Real Talk with Cale Madison. Each month I'll be back with the latest on the Geelong property market, what's changing, what it means for your investment, and what to do about it. Follow us at Jealous Craig Geelong on YouTube, podcasts, Facebook, Instagram and LinkedIn so you never miss an episode. Until next month, invest smart, Geelong.